Welcome back to our channel. I have again the honor to have Martin Tixier here. Martin is a great friend, but he's also an expert on credit and the global strategies on all asset classes. I think we are living in quite a dangerous time now, also for as an investor, and we see two streams of risk probably even merging. One is what is happening in Iran. And the second one is the private credit. More and more funds are closing for redemption. So I think it's a good time to have Martin here and again discuss what has happening since our last video. Welcome, Martin. Great to have you
Welcome.
here.
Welcome
You
again.
No, absolutely. So it's always a pleasure to discuss. Even it's are quite serious times also for
Yes.
investors, and portfolio protection is not easy. But you again, were quite productive and wrote a new piece in your Substack with the title Reminiscences of a Credit Operator. So, and it's quite interesting because I read the book, which was still, when was it, in the 1920? But
Absolutely.
I
1923, yes,
no,
it was
absolutely.
published.
So I give you the floor to probably it's also for the viewers, it's also interesting to give a bit of background on Lefebvre, who wrote that book, and what you had in mind with that title.
Sure. Well, this book is a must-read book for any kind of aspiring trader or portfolio manager, and it's still very relevant, although it was written in 1923 during the Roaring Twenties. And the character of the book is directly mirrored against the real trader at the time, which was a maverick and prolific trader called Jesse Livermore, which was legendary for his skills in timing the market as well, shorting and being leveraged on the market, and using as well market manipulation to have outside gains. It's quite interesting for several reasons. There's been some recent news on Bloomberg and on the financial Twittersphere relating to some suspicious trading activity relating to oil as well as capital market prior to some Donald Trump announcements in relation to the oil market as well as NASDAQ linked to what's happening with the war against Iran. It's quite interesting to have this kind of relation to Jesse Livermore, which was a master market manipulator before the creation of the Securities and Exchange Commission in 1934. As well, on top of that, during the Roaring Twenties, the market was going into overdrive, which was due as well to a lot of people speculating on the stock markets. Now, in current days, we've seen that there's a huge amount of money being bet on the Kalshi betting platform as well as on Poly Market. And really, it has gone into overdrive. It seems like the whole market is becoming like casino-like. So that's why I used the title reference to Jesse Livermore, because as Mark Twain used to say, history doesn't repeat, but it does rhymes. And in the previous conversation, we mentioned as well our 2007 vibes because of what we're seeing into the market. And as well, what I quoted into my last Substack publication was the very good interview made recently by Jeff Gundlach relating to what he was seeing in the private credit market, calling it an unmitigated disaster, quote him verbatim. He's seeing as well the similar concerns we discussed, you and I, relating to 2007, with the big difference is that you lack price indicators like we had in the 2006 period, such as the ABX CDS indices in private credit. Because of the illiquidity, you don't have like the CDS prices to give you exactly what's going on under the radar. When you have like active secondary trading in both the bond space as well as the loan space, then you have already some early warnings about the deterioration of the credit profile of a specific issuer or a specific bond issue. In private credit, given the very large difference of marks of the positions, it's very difficult to ascertain what is the value of the underlying. As such, it creates, as we mentioned in the last conversation, what George Soros would call reflexivity. And people tend to shoot first, ask questions later. As we said in the previous conversation, it's not that all the private credit markets are totally rotten to the core. Absolutely not. But uncertainty creates nervousness. And as such, that's why you're seeing so many demands for redemptions, creating very large pressure in markets which are already very nervous and very strained. And that's why we have seen a lot of private credit funds getting gated, but as well it is extended, as you mentioned as well, I think recently, to the real estate space. You might want to talk about what's happening with, I think it's a UBS fund in real estate, which has been gated for the next 3 years. I think maybe you can talk a little bit more on that, on this specific thing.
Absolutely. It I made also a LinkedIn post on that, which got quite more than 15,000 views. So I usually don't get as much attention when I post. And it's interesting. It's a German open-ended fund. I don't like that kind of structure because it's for retail investors. It offers daily liquidity at an illiquid asset, and almost in all times, every times we had a crisis, it something happens and gives you a bad headline risk, and that fund was already I think almost winding down, and it's all they have like really only quite a bad part of the portfolio left. Actually, I think they sold even some good assets already, and you see it has more than what was it, more than a 15% vacancy rate. You see that in those type of structures, and I don't like actually those structure for retail clients. Some people misunderstood me because I was saying, yeah, the regulator should really change its regulation. Some people said, yeah, you shouldn't now cry for the regulation, but if you have a bad regulation, you should change that regulation. But it just shows how in such times illiquid assets in liquid structures usually have issues, and if the wave is then too high, then you need to close down, and usually it's argued for the protection of investors, but uh, often such products are then liquidated and investors make huge losses on it. So there were also some better cases, but I'm usually quite careful not investing in this type of products. But coming back to the credit,
Yes.
and as we see like what's happening in Iran, and if we compound that with the issues in private credit, that could be something which
Yeah, I would say a rogue wave. Exactly. It's similar to a kind of perfect storm because we already mentioned that before the Iran events, you had the credit cycle, which has obviously turned. We were already seeing it in the weakness in total return for US high yield triple Cs. The issue as well, there's a very significant correlation with outflows in ETF in US high yield. If I take the ETF HYG, it's always a very good indicator in terms of correlation with equities market about potential risk off. The correlation between the ETF HIG and the S&P 500 or even the Nasdaq is very, very high. We're close to 80% correlation. That's why I always monitor very, very closely what is happening in terms of outflows because ETF is a retail product which provides daily liquidity on the illiquid part of the market, which is like US high yield. So in similar fashion, when you start to seeing a stampede out of the riskiest part of the credit spectrum, then it gives you cues about the acceleration, the potential acceleration in the correction in high beta markets. And credit, I always tend to think lead equities as such. And there was a paper which was published by the Wharton University about using flows of U.S. high yield funds to have some cues in relation to what can be happening into not only like risk assets, but as well as an early economic indicator. And this paper was published by Ite Goldstein, and it was mentioned by the Wharton University in September 2018. And it was a very interesting paper when you think about the signal which are provided by credit, particularly the weaker part for the rest of the economy. For me, credit is always a leading indicator, and given that we've seen a weakening in triple Cs and now outflows, not only in high yield funds but as well in private credit, gated real estate funds, it really tells you that yes, the credit cycle has turned, but on top of that, you have an exogenous factor which is created by supply destruction due to the war in the Middle East. So the conjunction of the two factors can be very significant in the current environment. So the name of the game, I think, is not a question of appreciation of capital right now, much more about preservation of capital, and as such, the need to be extremely defensive, which is also what was mentioned by Jeffrey Gundlach in his very good interviews about the need to have international diversification equities-wise, the need to have very short duration, which we mentioned as well at the end of our previous conversation, because we've seen that since the beginning of the month of March, the U.S. 10-year was trading around 3.95% yield. Now we're close to 4.46%. So the convexity factor, even on investment grade, creates very significant headwinds. And in fact, you could see that the performance of the ETF LQD, which is for U.S. investment grade, in terms of performance with ETF HYG, which is for U.S. high yield, is roughly the same, and it's highly negative as well. So both are falling. So it's not only a question of rush to quality, but duration exposure means that you don't get protection from U.S. investment grade unless you are very low duration. So that's a little bit of a very significant difference from the past, where people were finding refuge in the traditional 60-40 portfolios, where the fixed income side was preventing the losses you were getting on the equity sides. And right now, because of rising dispersions and the credit cycle turning, we see that most of the correlations are close to one. So everything is moving in the same direction. Even gold, which was considered as a safe haven, has sold off quite significantly. I think much more due to the liquidity factor. In a crisis, when you have to raise liquidity, sometimes you don't sell what you want, you sell what you can. And as you mentioned, for the UBS real estate funds, or for any kind of real estate funds, or some private credit funds, they tend to sell the quality asset first because
Absolutely,
they are the more liquid ones. And the issue with this kind of strategy is that overall it starts degrading the overall quality of the portfolio, because what goes out is what is the best quality stuff, and then you're left with the less liquid, the less quality things hanging on the portfolio. And because of reflexivity, people are panicking, so they try to shoot first and think later, and that's why you have sometimes stampede on even more quality funds, because people react following a herd mentality, so they're all rushing at the same time for the exit.
Yeah, but if we look at the financial markets reaction, especially in the equities, it's still quite measured. If we think what kind of risk could happen and what kind of outcomes also could happen, I have a bad feeling that we could end up in a 2, 3, 4 sigma event very soon. So it's just a tail risk, but nobody knows when a 4 sigma event would happen. Otherwise, I would be already very rich. But I have a bad feeling that we really the ingredients are there for that we get over the coming weeks such a thing. I still hope we can avoid it. I think you had also an analogy with the boat,
Absolutely.
which you
No,
wanted to
yeah,
mention.
it's pretty crazy, but it's a true story, and it really explained the different kind of waves and risk and outside risk and tail risk, as you mentioned, because it's a very good illustration about uh, a risk model is good up to a certain factor of standard deviation movement. So the illustration I would mention is there was a boat called the MS Munken, which was a massive 261.4 meter German lash carrier of the Hapag-Lloyd line, which totally was wiped out, disappeared out of the coast of South Africa in December 1978. What people tend to forget is very large ships such as this one. Most of them are built to withstand wave up to 15, 17 meters high. Now, most likely this boat encountered what is called a rogue wave. And a rogue wave is a totally different animal from normal waves. And these monsters can appear out of nowhere due to a conjunction of factors, currents, very strong wind, low depression. And they tend to appear in some clusters in some region, such as the coast of South Africa. And after some very serious studies, boats are now navigating a little bit further than the coast of the Cape,
Mm,
right at the bottom of South Africa, because the probability of encountering such rogue waves are higher the closer you are to the coast.
yeah.
And why did I use this analogy? Because most models are made to, okay, you have a 99.1 interval of confidence, your value at risk measure a significant, can withstand a significant standard deviation movement, maybe 2 to 3, maybe 4 standard deviation movement. But what if you get a standard deviation movement of 8? Then your VAR model
Mhm.
doesn't resist. So how do you diversify when correlation are going towards 1? How do you preserve your capital? Well, you need to first, as Jeffrey Gunlack underlined, you need to go through international diversification. I think, as he mentioned, investing outside of the US could be a good idea, because right now, still the trajectory of the US budget is out of control and wars are extremely inflationary on top of the exogenous
Mhm.
factor we're seeing. So, investing in countries like Brazil, the energy sector, for example, playing the commodities champions such as Brazil is not a bad idea from a diversification point of view. And there's
Mhm.
also another asset class which is of great interest, which people don't really know about, which are catastrophe bonds. Now, these type of animals are absolutely decorrelated from both equities and bond markets, because they are insurance on very large disasters such as earthquakes, such as hurricane. And these asset class are made of, these cat bond funds are made of very, very diversified, very highly complex portfolios of bonds, which are linked to the reinsurance business. The good point about this category of, I would say, alternative investment is that the coupon is mostly floating on the securities within the
Mhm.
portfolio. So it gives you as well some upside. It gives you some decorrelation, but it has as well some kind of similar issue of private credit, which is it's not as liquid as some of our products per se.
Mhm.
And these products, I think the holding period should be in the region of 3 to 5 years. Allocation should be in the region of maybe 5 to 10%, even it could be more. And the idea about these funds is having some decorrelated returns in a very choppy, very, very volatile environment. And these funds have proven in the past that they are very good alternative when you have like positive correlations everywhere. You want to stick to decorrelated assets. And I think it's part of the tool you can have in your portfolio toolbox when you have to rebalance your portfolio and add to some decorrelated exposure as a protection measure in this kind of environment as well.
Yeah.
And I think on your side, we discussed as well potential protection coming from like residential housing for students as a part of a real estate tool that can mitigate the returns in a stagflationary environment. Maybe
Yeah,
you
yeah,
want to say a
absolutely.
little bit more on that.
Absolutely. In such an environment, you want to have like short-dated cash flows which adapt then to inflation. That usually you like as a real estate investor have long-term fixed contracts, but in such a time, it's better to have then short-dated contracts that can be. For example, one is like U.S. residential, which has rent at the multifamily rent. It can be like hospitality has also like short-term leases, and we have some operational sectors also like student housing also that usually are favorable in such an environment. So let's hope we don't need all that portfolio protection and things prove out a bit more on the optimistic side than we than we are afraid of here. But so hopefully we don't have like a Six Sigma event before our next call, Martin. But we will continue those discussions. I don't know if you have also a final comment on your side, what you would give to our viewers.
Well, I think it's time to play defense, to be very, very aggressive in terms of being defensive on the portfolio, which means raising the cash levels for sure. Diversification, having international diversified equities is also a mitigating factor. You want to avoid what is long duration exposures, such as technology stocks for sure, long duration assets, because we've seen that the current rise in bond volatility, which has been very significant, if we look at the MOVE index, has been very detrimental convexity-wise for the long end, for both U.S. Treasuries as well as for investment grade. But it's also the case that we've seen a significant sell-off in emerging debt local currencies because it's as well, no matter how high the coupons are, it's still high beta. So it's quite difficult, it's quite treacherous to navigate such an environment, particularly if the specter of stagflation is rising significantly because of the supply shock coming from the Middle East wars. As such, I think there's a lot of ways to mitigate the credit exposure by staying low duration, by favoring very strong balance sheets, very strong companies with very strong abilities to generate positive free cash flows, even in a downturn. So it's, as we said, we've seen rising dispersions, which for us were a sign that the credit cycle was turning. So as the market becomes more complicated, you need to become much more selective in terms of the issuer profile and adopt a much more active management to navigate these very treacherous waters going forward, I think.